It's no surprise that people are worried about the economy in the US, but across the rest of the world as well in this day and age. Quite frankly, it's silly not to worry about the economy. Ever since COVID came and governments shut everything down across the world, a massive recession has been just a matter of time. It seems though it's finally here, with US GDP figures falling for 2 consecutive quarters, meaning the United States is actually officially in a recession, and many other countries around the world are in a very similar position. It's no surprise then to see that people are looking to the past to see what might happen next this time around, with the most recent major recession being the 2008 financial crisis, which has startling similarities to what we're seeing today. Now this presents a problem because we all know how that ended. A massive credit crunch, loans going unpaid all over the world, asset prices crashing, and banks collapsing as well. It's just a little bit worrying to look at the circumstances today then, because they seem so awfully similar to what went on back then. Today in particular though, warning signs are flashing for banks in America and in Europe, showing that they might just be on the brink of collapse again, and we might be about to have another Lehman moment. Now, there are lots of fundamental problems in the economy right now for obvious reasons, and this goes across all industries. This isn't just reserved for the financial sector, but of course, banking is no different in that sense, because inflation hurts banks as well. Wages need to go up to pay staff too, and they've never gone up as quickly as they have over the last year, where we've seen a pretty crazy bidding war for young talent in the investment banking industry over this last year. The lowest level employees in a bunch of different banks are earning or getting paid 30% more than they would have done a year ago, and these are hundreds of thousands of employees across the entire world. On top of that, they're also already paid a lot of money, above $100,000 a year often, so a 30% pay rise is $30,000 extra per employee, and that's a massive cost that has to be eaten by the banks. There are some good signs to this on the surface though, because high inflation means higher rate hikes from the Federal Reserve, and that means higher interest rates being able to be charged to customers, and that makes banks more money, so this should be good news, right? Well, the reality is that the customers paying these higher levels of interest are poorer than they've ever been, with wages that have massively lagged behind inflation. And as of right now, they are for the most part still paying their debt, but these higher rates will lead to higher levels of default in the future. As we saw in 2008, when this happens en masse, banks suffer as their loans aren't repaid, and that led to the collapse of many banks back then. There's also a massive problem right now surrounding banks and a potential liquidity crisis, which is getting close to those crisis levels. Bond markets are quite frankly spiraling out of control, with bond prices crashing and yields soaring because banks aren't buying up as many bonds as people expected. Simply put, these banks don't have the liquidity or the money that they expected to have, and as a result, they can't carry out their fundamentally important roles that they have in the markets. Now, for investors, 2022 has been a very difficult year, as we're finally paying the price for inflation in our asset prices. Goldman Sachs even released a shocking report a couple of weeks ago, saying the classic stock and bond strategy won't be enough to keep investors afloat, and that's not really surprising, with almost all companies losing value this year and the S&P 500 falling by well over 20%. As a result, Goldman Sachs says the ideal allocation for stocks has shrunk from 60% to around 45%. But what do they recommend you do with that difference in order to salvage your portfolio? Well, they say you should invest in real assets like art, and that it can not only protect your purchasing power, but the last time inflation was this high, art appreciated more than real estate and even gold. So how do we invest in fine art? Well, with this video's sponsor, Masterworks, of course. Now, I've been working with Masterworks for almost a full year now, and well, just take a look at their results so far. 6 pieces of art have been bought and then sold for an average net return of 29% to investors, and that's during COVID and the subsequent bear market of 2022. As a result of this brilliant performance, Masterworks has had to acquire and release more art on their platform to meet demand, and there is now a waitlist to join, but you can skip that waitlist by clicking the link in the description of this video. So go ahead and join the thousands of other Stoic Finance subscribers and click the link down below in the description. This here is coming straight from Bloomberg. Liquidity metrics for the US government debt market are approaching crisis levels after a year of steep losses for bonds caused by rising inflation and Federal Reserve interest rate increases. And with the central bank simultaneously cutting some of its holdings, the situation may worsen. Treasury Secretary Janet Yellen expressed concern about it last week. When we warned last week that Treasury buybacks might begin to enter the debt management conversation, we didn't expect them to jump so abruptly into the limelight. September's liquidity strains may have sharpened the Treasury's interest in buybacks, but this is not just a knee-jerk response to recent market developments. Right now as we speak, the US Treasury is even considering intervening in the financial markets to try and provide some liquidity to the system to stop it all from falling apart. In short, the financial system is in a much tougher space than most people realize right now. Now, you've probably seen the news about Credit Suisse and Deutsche Bank being on the brink of failure over recent weeks. Credit Suisse in particular got loads of bad press because they're losing money constantly, but they have a claimed fix for this issue in the works, which is this brand new plan to revolutionize their business and save them from their failings. The problem is, a few weeks ago, they had to go scavenging from all of their clients to ask them for more money because they can't afford to put this plan into action. Without this plan, let's not forget, they cannot solve their problems on a fundamental level, and it also turns out they don't have the money to put this plan into action, so this sent alarm bells ringing as you would expect, which were then sent ringing even further when the literal CEO of the company sent round an entire company memo basically saying, everything's fine, we're a strong bank with no problems, so stop panicking. Was all sorted then? Well, no, because then they started even asking more of their customers and investors for money, so it seemed things were really not okay. Deutsche Bank is now in a very similar situation, as it's just a very poorly run bank with loads of debt that it can't seem to make work. Then last week, we started hearing that Swiss banks are using a special dollar swap facility that the Federal Reserve created to buy up as many US dollars as possible, and they're using it more than they have for 14 years. The last time they used it this much was after Lehman Brothers collapsed in the 2008 global financial crisis. The legacy media's claim is that this is all in a bid for an easy profit, but what seems more likely is that this is actually done out of desperation, as they just don't have many other options left. 17 banks altogether have taken up over $11 billion of US dollars in just one day last week, and for the auction before that one, they bought up over $6 billion. We do not believe that the increased demand for US dollar liquidity by domestic banks reflects any liquidity issues in the Swiss banking system, Credit Suisse economist Maxime Botteron wrote in a report last week. That's literally the line coming out of Credit Suisse, the failing bank, but to actually believe them when they say this would frankly be absurd. Sadly, the Swiss authorities won't actually tell us which banks in particular are buying up these dollars, just that they are being bought up at a rate not seen since Lehman Brothers collapsed. The reason they're not telling us? Well, probably because they don't want us to know which banks are actually in trouble. But that's just what's happening in Europe. I hear you say, what's happening with American banks over in the US? Well, in short, things are starting to look strained. In the short term, as earlier mentioned, banks in the US are making more money as the Federal Reserve raises interest rates, and they can then charge more interest for mortgages, for car loans, for credit cards, and for all kinds of debt. But as that happens, the markets are changing rapidly and their customers will basically go bankrupt. Car repossessions are at the highest levels we've seen in over a decade. New mortgage applications are dropping off a cliff as people simply can't afford to buy homes anymore, and credit cards are more and more frequently going unpaid. This will of course all go on to impact the big American banks and hurt them to their core. At the exact same time as that's happening, equity prices are still dropping week by week as the recession truly takes hold. JP Morgan last quarter booked $1 billion in losses on their equity positions, and the same story can be told about all the other big American banks as well. Some other banks, though, are just outright performing even worse. JP Morgan has still at least managed to grow its profit in the short term thanks to these rise in interest rates, but Wells Fargo and some other less successful banks are seeing their profits decrease every quarter now. Wells Fargo in particular saw its revenue fall almost 8% over the last year, with its profits falling by 31%, wiping out almost all of the gains it made the year prior. One of the biggest fears, though, is about quantitative tightening and the impact that this will have on bank deposits. Now, under usual money printing conditions or quantitative easing as we've seen in recent years, banks are essentially encouraged and find it really easy to get their investors or customers to deposit more cash, as that monetary policy is all about boosting the economy and the money supply. With quantitative tightening, though, the opposite thing happens and banks find themselves struggling to get the same levels of deposits. Now, this money that you deposit in a bank is then used by that bank to collateralize all of their risky bets and investments, and without them, they plain and simply can't function. Quantitative tightening is now almost in full swing, and it's not going to stop anytime soon, which means the capital at these banks' disposals to actually pay off these debts and act as market makers is going to continue to decrease. Now, these banks know this as well, and Jamie Dimon, the head and the CEO of JP Morgan, who has been in that position for almost 2 decades at this point, and he's run the bank through the last global financial crisis, well, he's warning that he is sure the US is going into a full-blown recession, one that no one will be able to deny, unlike the recession we're currently seeing in 2022. Now, all of this points to similar things as what's happening in Europe. Banks are losing money on their assets and their investments because all asset prices are falling. Banks are scared about collateral drying up as well as quantitative tightening takes effect. And as consumers suffer under these high interest rates, the cash cow that is currently holding up banks like JP Morgan is going to dry up too. Now, the main fear that people have right now is that accounts may just outright be frozen in an attempt to stop bank runs. Now, we all know these banks aren't fully capitalized, and if we all tried to take our money out at once, even if they were on good conditions and there was no recession, then these banks would collapse. Because this isn't just allowed by law, it's actually encouraged. As news of the bank's poor performance gets more mainstream and more negative, though, consumer sentiment and trust around these banks will slowly start to decrease and to erode away, and we may well get to a point where people aren't comfortable having their money in these banks at all. The only sensible action for these consumers and these customers will be to take their cash out, but that itself will be causing the very problem that these people fear. Bank runs would frankly be devastating, and there's not a single bank in America that could survive one without serious damage. The only result then would be for them to freeze people's accounts, to say, no, you're not allowed to take your money out right now because we actually need it more. Another likely possibility of what might happen in an attempt to stop this from ever becoming a problem is that banks may institute a credit freeze or a credit crunch. They need to increase the reserves they have in comparison to the loans they gave, so they can either increase those reserves or in this case decrease the size of their loans. This would make them less likely to collapse, but would also come at great cost to the underlying company and actually the economy as a whole. If they take away your credit limit or cut it in half, or if they refuse to give you a car loan or a mortgage, they will then miss out on those interest payments, which are the only things that are keeping these banks' profits so high right now. But also, this will damage spending in the economy. Debt is a massive driver of economic growth, but as debt gets more risky, the willingness of banks to give it out is only going to decrease, and this will make the likelihood of a serious recession even worse, as spending will dry up when people lose access to credit and to loans. Finally, one other idea that is worrying a lot of people right now is the idea of a bail-in as opposed to a bail-out if the banks should crash and they have to save them. Now, back in 2008, of course, we had bailouts across the board and in most countries where the governments basically propped the banks up to keep them running at an insane cost to the taxpayer. This time around, though, speculation is rising of a bail-in where the government would not physically give banks their cash, but they would just allow the banks to steal your cash to keep themselves afloat. In a way to compensate us all for that theft, the banks would likely give us shares to the company of an equivalent amount of what was stolen, but who really wants shares in a failing bank that has to steal from its customers? Well, no one, of course, so the chances are you will almost definitely get shafted here with shares that aren't worth what they claim they are. The argument that the government will make for this is that this will save the taxpayer money, but in reality, the cost would just be borne by those who are stolen from in the exact same way as taxes are stolen from citizens every year. Contrary to popular belief, this has happened before, and in particular, it happened in Cyprus in 2013, where anyone with more than 100,000 euros was forced to essentially bail out their own bank in return for rather pathetic amounts of shares in the companies that had stolen from them. Needless to say, this would not be a desirable outcome at all. The state of the banking industry all around the world is obviously not looking great, but I will make sure to keep you all as updated as I can. So until next time, stay stoic.